Hello everyone, welcome to Module 3. I hope you had a good break after Module 2 and are ready to get back at it. In this chapter of our course, we're going to be looking at instances where the MACD crossover event that we referred to in Module 2 is not valid. It's a garbage signal. It's giving you information suggesting that you go in the opposite direction that you should, aka fake-out signals. We noted at the very beginning that these do happen. They're a fact of life. MACD is a great tool, but unfortunately there's no indicator that's 100% correct or valid all of the time. So what we have to do is arm ourselves and equip ourselves with the tools to identify those false signals and figure out a way to trade around them. So we're going to start off with here is defining what we mean by counter trend pullback. That's a sort of a fancy sounding phrase. It's not intended to be. What we're really talking about is any instance of a short-term or finite, short-lived move of price action headed in the wrong direction, quote unquote. Now, there is no such thing as right or wrong in the market. Price just goes wherever it needs to. But by wrong direction, what we mean is that if we have an established bias or trend that's intact on a higher level, then when price deviates from that trend on a lower level time frame, heading in the wrong way or the wrong direction, this is a pullback. And it's very important to point out that, of course, there are valid reversals, but in this instance we're talking about seeming reversals that are not valid. They're just not justified by the various elements of what's going on different time frames. Now, why is a counter-trend pullback significant? Why should we focus our attention on it? This course is predicated on the philosophy that, just like Forex Mentor talks about, Peter Bain talks about, if the trend is up, we're not really interested in trying to be fancy and contrarian and, scalp counter-trend moves. If the trend is up, we're looking to buy the dips. If the trend is up but price decides to just tank a little bit or move sideways, we're not trying to ride that counter trend action. We're just looking for it to be finished so we can buy that dip and get back on trend. And similarly, if the trend is down, we're not really trying to buy rallies. We're looking to sell rallies when they're finished. Now, the advantage to you as a trader from applying this approach is that you can use stops that are tighter, closer to the action, that will generally withstand any of the low-level noise and survive the trade. And of course, the flip side of that is that you will have fewer instances of drawdowns that really test your mettle and get you a little bit nervous, fewer whipsaws that can affect your trade, and by improving your entry point for the trade on trend, of course, that maximizes your profit for each individual lot that you take on the position. So those are some of the benefits of trading on trend, and counter trend pullbacks are just quite simply the mechanism that we use to identify when we want to get back in on a correction or a resolution into the trend. Now that we've more or less defined what a pullback is, let's consider what sorts of things MACD will do in that type of situation. Well, generically what you're going to get is a fake-out signal. So, for example, if the move or the trend is down, but you get a bullish crossover with MACD, then heading up with angle and separation, that could constitute your fake-out signal. Or similarly, if you're in the midst of an uptrend or up move, a bearish crossover from above the waterline with angle and separation heading down may constitute the fake-out signal. So in other words, telling you to go the wrong direction. Now there's always going to be exceptions to this. You can get that type of signal going the wrong way in a trend, and there might be a move there for you. But we're just saying again, to stick to the more conservative philosophy of trading, we're really trying to stay on the trend or on move. And by trend, we're using that term fairly loosely, not necessarily what the direction of the 200 period moving average on a daily chart is, but it's just whatever the protracted bias is in the session that you're trading. So the trend might be down on the daily, but maybe you have a good 200 pip move off of support on an S2 pivot, say. That would constitute our move that we're looking at. So anything that's contrarian to that is counter trend. So if you respond to these fake out signals with a very mechanical, simplistic approach, just seeing a bearish crossover and always interpreting that as a signal to go short or to think short, you could find yourself in trouble quite often. So it's very important to always look at the total chart environment. And what we're going to do for the balance of most of this module is look at, I believe, a total of 5 different strategies for reading signals from MACD in context, and then also figuring out how to trade them, most particularly the resolution back onto trend. Okay, here's a simple yet very effective illustration of what a counter trend pullback looks like, both with respect to price and MACD itself. So the first thing I want to highlight is just this bullish crossover on MACD down here. And again, if you took a very simplistic mechanical attitude towards it, you might say, okay, well, this is a long signal. And depending on what kind of time frame this chart was, I don't honestly recall, you actually see that you did get a bit of an up move. But if this was, say, a 15-minute or a 30 or 60-minute chart, that might not have been a lot of pips. And to really get in and out with profit, you would have had to be extremely sharp with your timing, and it would have been very easy to get blown out of the water just on one single close of a bearish candle over here. So this kind of demonstrates the danger of going long when the trend is clearly down. Okay, and our trend following indicator on this chart is a pair of exponential moving averages. The gold line at the top, a 200 period EMA, and this dashed blue line, a 100 period EMA. Now, after this bullish crossover on MACD, price did penetrate the 100 period moving average, but we noticed that it failed to take out the 200 period. Even if it did take out the 200 period, we'd need to see a lot of other clues, because price could penetrate the 200, resulting in what's known as a head fake, and then come right back down again. So we'd want to see lots of other clues that this thing was reversing and going up. But looking in the background on price action itself over here, I don't see a whole heck of a lot of real compelling proof of a long setup. We don't have a really strong or sharply defined bottom reversal pattern. I guess you could call this a 1, 2, 3 if you were really hard pressed, but even the trend line break here wouldn't have given you much. So price goes up, fails to take out the 200, and then subsequently, this is not the best drawn trend line, but price did break this trend line on a very sharply bearish candle. And that downtrend resumption was signaled by a bearish crossover on MACD. And then we can see, of course, what happened. Once we got back on trend, it continued on down, and we would have been really well situated with a short move, as opposed to trying in vain to try and go along with this counter trend up move, which was very short-lived and really kind of bucking the trend. So that is a very simple illustration of a counter trend pullback and what MACD might do, issuing you fake out signals along the way. Okay, so here's the first of several techniques that we're going to use to try and identify pullbacks that are counter trend and therefore flag crossover events happening on MACD as potentially as fake outs. And the basic principle that we're going to work with is that if you have a trend on one time frame that remains intact and is showing no signs of weakening or let up, then the quasi reversal pattern you have on the lower time frame may be invalid. Not necessarily, but may be invalid. And we're taking the attitude, therefore, that the counter trend run is more likely to be short-lived and just generally difficult to trade. So we're not going to even try. We're going to wait for a confirming signal of some type, several types preferably, that the counter trend move is over, and when it is, we're going to jump back in and either buy the dip in an uptrend or sell the rally in a downtrend. So just a really simple illustration of that kind of concept would be that if you have an up move on an intraday chart versus a very clear downtrend on a higher level time frame, I put in brackets here daily, but that's really, in effect, that's probably too wide a discrepancy between the time frames. You really want to try and sort of get them a little bit closer to each other, such as a 4 hour and 1 hour, or maybe 2 hour and 15 minutes, because you can actually have good moves on the 15-minute chart that don't line up with the daily, but are still tradable. But the essence being, just stacking up those time frames side by side. So the first thing you need to do is figure out what trend following indicators you want to use along with MACD, and just quite simply compare the readings on the one time frame against the other to see if that gives you any clues. So what we're going to do now is look at a chart example that does that, puts two time frames together, and we're going to see if we can get some idea as to whether a down move is counter trend or not. Okay, so here we have a daily chart for the Kiwi Yen pair. That's NZDJPY. And on the right we have a 3-hour chart. And what we're going to do is start off by looking at the first fake out signal at MACD. And that's this bearish crossover here. How do I know it's a fake out signal? Well, what I want to do is I want to consider everything that's happening on my daily chart at the time I get the signal. Okay, so this arrow to the left is showing us this bearish candle, and it was a fairly steep bearish candle, and I don't have the scale shown to the right, but this is probably a pretty good number of pips actually, and if you were skillful enough to be able to pick some pretty good targets and scalp this move, you could have got a nice little move here. But again, we're not trying to espouse that approach at this point. What we're trying to do is trade with the trend. So the first thing that we would have done after seeing this bearish crossover event on MACD is notice that regardless how steep the angle and separation was here, and again, it's a little bit exaggerated because I had to sort of squish two price panels into one screen, but it is still very bearish. We are going to flip our attention right away to what's going on in the daily. So with MACD, it was the exact opposite scenario. Even with this sharply bearish candle on the daily chart, MACD was showing no signs whatsoever of letting up. This was a very strong bullish reading that we were getting. Similarly, we had just seen a bullish crossover of the Guppy fast moving averages, this set of orange trend lines here, above the slow group, and there was continued angle and separation on that indicator as well. And so in effect what we're seeing with this strongly bullish 200 period exponential moving average, this yellow line, bullish MACD, prior bullish crossover in the near background on this Guppy multiple moving average system, all the indicators that we've got plotted here are showing no signs of let up whatsoever. So what we would have wanted to do, again, is wait for a signal or a sign that this down move was over. And that came from a couple of hits on this rising 200 period exponential moving average, and that was subsequently confirmed by this bullish crossover on MACD. Now when we say continuation crossover, here's an example of one. It's a continuation crossover because it's crossing over in the direction of the prevailing trend after a prior counter trend move. So this signal would have given us some comfort in addition to the fact that price had achieved really good support and bounced off this 200 period moving average. So I can't show you the full spectrum of intraday charts for this trade just to keep the page count under control, but what we would have done as soon as we saw this bounce off the 200, we would have immediately drilled down to various lower level time frames, trying to cobble together a confluence of events to get us in on the long side as well. So we would have looked at trendline breaks, daily pivots, oscillator readings of various types on the lower level time frames, and hopefully get us in long with the prevailing trend on the daily. So we can see what happened here actually. If this move on the daily chart was finished at the 83 level, which is where my cursor is, subsequently as a nice position trade, it went up to 88 on this chart time frame, and in fact, if you look back in history, the Kiwi Yen pair went at least as high as the 97 level by summer 2007. So a really great example of how what looks to be a really robust down move, well it was, but it was going the wrong way, and once it hit the brakes, it was then time to really get in line with the trending indicators on the daily. So that shows us how we can read contrarian readings on MACD and other indicators on one time frame versus a still intact trend on the higher level time frames. Now you can get your clues as to a pullback and a fake out sometimes on the very same time frame you're dealing with, or the one in which you see the crossover event on MACD, without necessarily even having to consult higher time frames, although we know we're always working with the multiple time frame approach. So the first thing you want to do in this technique is flag the MACD crossover. Just draw a circle around it, something to draw your attention to it. Then you want to consider which way the various moving averages you're working with are trending. So if they're maintaining positive angle and separation between them, you would assume the bias or the trend is bullish, and then of course if they have negative angle and separation, you're thinking bearish or short. So then we want to compare and contrast these two elements. So if MACD is giving you a crossover event in the direction opposite the moving averages, you know you might be looking at a fake out. Then you want to consider price action relation to the moving averages. So, for example, if you have a 200 period moving average that's rising, if price is not touching or penetrating it, the moving average is providing support and outlining the trend still intact. That's another piece of information to clue you in what's happening there. And what we want to subsequently do is then wait for MACD to cross over in the opposite direction from whence it came to get us back on trend with the market. So let's take a look at a chart example that demonstrates these principles now. So this chart gives us a pair of exponential moving averages, a slower one, which is the purple line at the bottom, and a faster one, the blue line. And we're not going to really even concern ourselves with what the period settings are. It doesn't really matter for the purpose of this example. What we're going to do is notice, first of all, that there was this interesting event back here, way back to the left-hand side of the chart, which is this golden cross of the faster moving average through the slower one. And so what we saw then is we had this increasing upslope on both moving averages, and the faster line pulled away from the slower more quickly. That physical gap increased over time, which tends to denote positive or bullish momentum. And so we take note of the fact that these two trend lines are giving us a very clear kind of uptrend signal or reading. So that by the time we see this bearish crossover in MACD over here, it's really giving us pause to think. Do we want to go short? Do we want to use that as a short signal? Probably not, because whatever price action results is going to most likely be counter trend unless we get a lot more proof. By the time we're up here, just after the bearish crossover in MACD, we can see that there's huge physical gap between the two lines. Now what happens is that price tumbles down, kind of plays with this moving average a little bit, but it ends up serving as a really clear support level. So our conclusion, with the gap being maintained between the two moving averages, no signs of a bearish crossover happening up here, and price finding support on the moving average, is that we probably did have a fake out signal with this bearish crossover. So again, thinking buy the dips, sell the rallies, what we want to do is wait for some really good bullish signals to kick in, and the first being on this chart, this bullish crossover in MACD, and that in turn validated a supply trendline break over here, and we can see that once price cleared through this trend line, the uptrend then was free to continue on uninterrupted. And if we drilled down to a lower level time frame somewhere around here, we would have started to look for some entry signals that would have helped us get in long. So hopefully this is a fairly good example for you of how, even though moving averages are lagging indicators, that can sometimes really work to our advantage when reading them in conjunction with crossover events on MACD. MACD in this case was just on the wrong side of the market far too early and was not giving us a true reversal, top reversal reading.